Hi everyone, today is Wednesday, April 23rd. The market just closed a few minutes ago. We finished up about 460 Dow points, up about 1.6% on the S&P. So we had a great day yesterday. And all of this is leading up to our message since the correction began. I think we've done 3 videos, which was, our discipline and our consistency is to stay the course, stay invested during markets like this. And what's been happening since the low on April 7th, where we had that real washout trade, all the way up to the steep rebound, one of some of the best days in history have happened in the last few weeks. Why you stay the course, and this is textbook why you stay the course. So we're going to be able to use this as a pretty good lesson. But as we've said, and again, I recommend you go watch the April 4th video just to kind of get refreshed so I don't repeat a lot of it here. But I have yet to see, and been doing this for almost 30 years, yet to see an investor liquidate sort of in a panic and get back in, see the market go down, get back into the market at lower levels. They usually get sucked in at much higher levels, and that is because markets bottom well before the news turns good and the average investor is going to feel it's safe. They're just going to think it's a bounce before it heads lower. Okay, so from we did the last video on April 4th, we kind of said, look, we're down a lot. We're down about 17% intraday, and we thought we'd see lower prices in the days ahead. The market would bottom a few days later on April 7th, where Trump went nuts on the Liberation Day, in terms of the tariffs being a worst case scenario for the markets, and the market finished intraday down 21% from the peak on February 19th. And that's the washout phase. And we're still in the washout phase. We're kind of in the rebound now, but we've done 3 waves down, and now we're 3 waves down and we're bouncing. We could see a 5th wave down to new lows, probably hit 4,200. The current low is 4,800 or so. I may be off. But we're just, the washout phase, the last real washout phase I watched was during March of COVID, when the market dropped 35%. And you see the Dow moving 2,000 or 3,000 points, or all of the markets moving between 1 and 3% every session. Down 3% one session, bouncing 3% the next session. Expert only, the average investor, and I mean sophisticated average investor, should stay out of that market. It's just whipping around a little bit. The only thing you really can do that we would recommend and feel good about is if you have some money to invest, to just do it slowly. Just put a little bit in every day, or a little bit in every few days, or every week, and just nibble on this thing a little bit. Don't put all your money that you have available in one shot. Just kind of graze into this market, and respect the downside, respect the volatility. Don't do enough that you're going to hurt yourself. You live to fight another day, and then eventually this thing will bottom. But again, expect when the low is in. You won't know it because the news will be horrible, and even after it's rebounding, it could be even worse news. But the market looks forward and prices in the future, so that news really hasn't happened. I do want you to understand, and if you did panic sell in the last couple of weeks at those lower levels, when we spoke on April 4th, the market would go down a lot more. And I know a lot of people sold into that low. We are now 12% higher than we were at the low, but here's the point. We are 7% higher than our last video. So if you sold it after that last video, because you couldn't take the pain, you're now trapped at much lower levels. We went lower than April 4th, but we're now 7% higher than we were on April 4th, 12% higher than the low. And if you miss that, your performance is going to really hurt. The price action we're seeing is totally normal. I want to go through the history of this market we've been in pretty much since the financial crisis. But let's just look at like the last 7 years, 2018 through today. It's about 6.5 years. 2018, we had a 24% correction. 2019, up really strong. 2020, the next year, was a 35% correction, right, with COVID. And then 2021 was very positive, almost bubble-like. 2022, S&P was down 25%, NASDAQ was down 30%. 23 and 24 were followed by up almost 60%. And then we've got this market in 2025. So we've had, it's been 1 down, 1 up, 1 down, 1 up, 1 down, 2 up for the past 7 years. So 6 or 7 years. Now let's go through the math of why you stay the course, why we think it's textbook. What's happened here in the last couple of months is exactly a lesson in individual investing. You need to be in the market for the best days of the year, even if it's a bear market, to perform with the averages. So we've had some of the best days in the market in the last couple of weeks, in the last 10, 15, even 20 years. And if you missed any of those, you're already behind the market. If you missed the 10 best trading days of a year by sitting on the sidelines safely in cash, trying to stay out of the volatility, if you missed the 10 best days, and most of those happened during the correction, you're going to perform 50% less than the average market if you just stayed the course. If you missed the best 30 days, basically sitting on the sidelines for a month out of the year and invested for 11 months, you're going to underperform the market by 83%. And that's a report I just read out of Hartford Funds. So it's fresh data. And if you sold at lower levels and missed those days, you're not going to be able to get back in reasonable time to meet your retirement goals. In fact, over the last 30 years, from 1994 to 2024, 1995 to 2024, 30 years, the 50 best days in that 30-year period, 50% of those best days happened during the bear market on the way down. 28% happened once the bear market bottomed. 28% of those 50 days happened in the first 2 months after the bull market resumed. And the other 22% occur over the course of the rest of the bull market. So if you miss that 78% of days, that's occurring during really, really volatile times. And only 22% of the 50 best days happened during the bull market. So like we always say, when that market goes down on bad news, you can't sell down there, because when it comes back, it's going to erupt like a cork out of a bottle. It's going to shoot up high, and you can't miss those days. And what we've just seen from April 4th, our last video, the bottom on the 7th, and where we are today, it speaks volumes. So, and let's talk about what's causing this volatility, and then I'm going to end with what retirees should be doing with their money and what we're doing with retirees, these people that don't work, that live off their portfolio in the current market. What's going on is the market is telling you loud and clear. It has spoken loudly. It does not like Trump's style of execution of his policies. It's not that the policies are good or bad. It's they don't like his approach, his execution of them. And we really don't get into politics here. This is not political at all. I'm just telling you a market reaction to what's going on in Washington. His negotiating style, he calls it negotiating, but it's very violent. It's very confrontational. It's even extortionist. We put 25% tariff on Canada. They match it with a 25% tariff. We double that. Like it's just nothing in terms of rational negotiation, and the market hates it. What got in trouble, and I'm sure he was visited the day before yesterday, and probably on the 7th by the Treasury Secretary, saying the financial system's starting to break with the selling pressure going on. When you see stock market go down, it's one thing, but when the fixed income, when the bond market goes down and the dollar goes down, that means they're selling up the dollar assets. They're selling stocks and they're selling bonds. And as bond prices go down and rates go up, well, we need to be able to refinance that debt and to issue bonds to run the government. And it's going to get more expensive. We're already running a massive deficit. One benefit of the bad stock market was that rates were going down. That lasted for a little while, but you didn't have rates breaking or bonds breaking down and the rates going up, and that's just not a good equation. That's when things start to break. That's when big banks fail, and when corporations can't roll commercial paper. But we're monitoring the CP market. We're monitoring corporate spreads. We have not seen that stress on the system. So, but what's happening now, and this is really important, I don't believe the market is telling you that nobody can take Trump seriously anymore. You can't take what he says he's going to do at face value. He puts on these massive tariffs, the market crashes, he rolls them back. And I think what happened with China today, he was talking about, we're gonna negotiate with China in there. I think he blinked. I think he blinked. He is not bigger than the market, and the market is in charge. So, and then you've got the stuff he does with, let's say Jerome Powell. A couple of days ago, he called him right out of the 5th grade recess playground a major loser. I like that one. And he has to go, and we're going to fire him. And to today, he's saying he had never had any intention on firing him. So that hot and cold, on and off, you just can't take it. Now I'm not even going to listen to it, because I can't react to the markets. I don't know what reality is until it actually goes into law. As far as our outlook for the rest of the year, it's very hard to predict stock market returns when you can't tell what earnings are going to be. And if we don't know what the tariffs are going to be, someone has to pay those, right? The tooth fairy doesn't pay the tariffs. So it's either going to be the producer selling the goods, it's going to be the company that buys those products to make products to sell in the US, or it's going to be the American consumer. So until we know, CEOs, CFOs can't make supply chain decisions, inventory decisions, if they don't know what it's going to cost, and stock market's not going to like that. So it's hard to do a prediction. I do think right now that fair value is right about where we are now. I'll call it between 5,300 on the S&P 500 and 5,600. And I do think any gains will happen in the second half of the year. There are some bullish undercurrents that I'll talk about. And if that does happen, as we head toward the end of the year, 2026 beginning, we could approach 6,000 on the S&P. And a lot of these bad days here are going to be forgotten. But again, something coming out of Washington, more violent, that could get in the way, and then anything geopolitical. can get in the way. So it's very hard, but we like 2 or 3 rate cuts as soon as June by the Fed. We think they're needed for one primary reason. They need to get mortgage rates lower. It's very hard for the Fed to cut when there are tariffs in place that are going to cause prices to go up, right? Inflation. So we'll see. But I think 2 or 3 rate cuts, and I am still optimistic that we break 5,800 on the S&P on the way up into year end, approaching 6,000. We will see, and it's hard to make a prediction. Let's end on what retirees should be doing in this market. And I define retiree as anybody who is not working, does not have an income, who lives off their portfolio to meet their lifestyle needs. If you are not retired and you have a job, and you're not living on your assets, I would just simply stay the course, keep investing in the market, keep doing your 401k allocations. If you're in retirement, which is the majority of the clients we work with, here's what I would say to handle a market like this. We wouldn't recommend selling anything, okay? And our typical client is 2 million and up, kind of in that 5 to 100 million, high net worth and ultra high net worth investors. But even then, no matter how much money, I said, look, if you want to raise 50 to 100,000, you have our blessing. We're not recommending it. If you have much lower amounts of money, then we're going to say, you want to take 5,000 out, 10,000, just something so that you have money for spending. Do it just literally for peace of mind. It's not enough that it's going to break your investment strategy for the future. But if you have an expense, maybe a car is coming off its lease that you're going to buy, or you have a tuition payment coming up, or you know how much money you're going to spend in the rest of the year. If you have an expense in 2025, at any point in the next, say 10 to 12 months, I'd have that money in a money market fund. You can now make over 4% in safe, risk-free money market funds, treasury bills. And so you're not going to be it's not like we're at 0 rates. I would do that. As far as we would not be selling the portfolio unless the asset allocation. So right now we are not down enough to alter how we're taking money. And here's how we do it. If a client is 50% in stocks and 50% in bonds, when we withdraw what they need to live on for the next month, quarter, 6 months, whatever they take out, we want to make sure the portfolio is back to 50-50, okay? If the stock market breaks down any much more than we are today, or we were at the lows a couple of weeks ago on the 7th, if it breaks any lower, when a client comes in for money, we're going to be selling cash and bonds and using that for their payments. We're going to be leaving the stock market alone, the stock holdings. We're going to keep them consistent. And we do that for 2 reasons. One is their allocation is going to be too low with the pressure in the market that if we take anything out of it, they're not going to have enough money to get whole, number one, and they're not going to have enough money to beat inflation over the rest of their lifetime for their expenses. So, and if it gets much lower, then we're going to not only let a client live off of their bonds and cash, but we're going to rebalance out of bonds and cash, sell those, and put them into the stock market to get back toward that target allocation. So markets are lower, we're not selling stock down there, right? As we've always said, we're going to be selling bonds and cash and buying stock. You buy low, you sell high. But it's the asset allocation that we watch, not the market, okay? I hope that makes sense. If not, call me, reach out to the team. We're doing lots of phone calls in here. We are bouncing. It feels pretty good in here. And I think the White House is learning that they need to chill a little bit on the rhetoric and the violentness of the rhetoric. So that's it. I wish you all, a good rest of the week, and we'll talk to you soon. Bye.